This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today is Scott Patterson. He's an author who has appeared on this podcast before, over 10 years ago, I believe. His new book is called Chaos Kings: How Wall Street Traders Make Billions in the New Age of Crisis. All kinds of interesting names in this podcast: Bill Ackman, Mark Spitznagel, Nassim Taleb, Daniel Kahneman, Cliff Asness. A lot of names you probably have heard about, a lot of really successful thinkers. Scott does a great job of taking a complicated story. I mean, look, it's very similar to trend following in a way, but taking a complicated story, breaking it down, adding a lot of color. I'm sure some people are going to like some things. I'm sure some people are not going to like some things, but hey, that's a good read. Without any further delay, let's jump right into my conversation with Scott Patterson. So Scott, I'm going to be the only interview that you're going to do where the interviewer has written 8 books essentially on the same topic, because the trend following books that I've written over the years, they're right in the same headspace. I still remember being fascinated all those years ago to find out who was on the other side of the Barings Bank trade, which happens to be the owner of the Boston Red Sox right now. And that sent me down the dusty trail of saying every time there was a big event, long-term capital management, summer of 98, or the dot-com crash, or October of 08, or March of 2020, or 2022, all these traders, these interesting traders that I write about, always just popped up because they were always doing exceptionally well during that time. And whether one wants to call it crisis alpha or big events, which as I've often called it, you're calling it chaos kings, it's all in that same headspace. I also want to add, though, too, what's interesting about your book is there's some of the players in there. They are very strong, opinionated players like Ackman, Spitznagel, Taleb. They've got some probably differing politics. And then you also add a strong dose of, perhaps I would characterize, your own political views in there as well. So this is a really interesting work that you've put together. How did this start?
Thanks for having me on, Michael. It started in the spring of 2020. And we all remember what was going on then. There was a lot of chaos at the time, obviously. And I had just moved back from London to the Washington, D.C. area. All hell was breaking loose. Things were crazy. The news broke that Mark Spitznagel's hedge fund Universa had clocked a 3,000% return in just those few months, which obviously caught everybody's attention. And it seemed like, how's that even possible? So we got a lot of news for that. I've known Mark for a long time. I've known him since around the mid-2000s. I actually wrote the first breaking news that he was launching Universa. I was quite interested in that. Then I came upon a paper that Nassim Taleb, Mark's longtime partner at various hedge funds, including Empirica, which they launched in 1999, the precursor to Universa. Taleb had written a paper in January warning about the risks of COVID. I was quite struck by the fact that he had seen what was coming so early. He's not an epidemiologist, but he's been writing about the risks of pandemics for a long time because they carry characteristics of what he calls black swans, these major unforeseen events that can have hugely unforeseeable outcomes and risks. Taleb had written that with a few other co-authors, and they were worrying that extreme measures needed to be taken to protect society from what this could be, because Nassim had been running some models on how contagious it seemed to be, and he grew quite alarmed. I was struck by the fact that these two people who have worked together for so long, they have similar views on risk as being much greater than people generally expect in various realms like financial markets or their area of expertise. It made me think There's something about the fact that these two people went through this period of extreme volatility and harm and market chaos and world chaos, and they came out of it looking pretty good. Mark, he protected his investors with his strategy. Nassim warned way ahead of most people that we need to be very diligent about this risk coming. I talked to Nassim around this time, and he told me that this paper, it was a one-page paper that he had written, that they had actually sent it to the Trump White House. It had been written at the request of a person in the National Security Council at the White House. But then they made it public soon after they gave it to the White House.
What's really interesting about the thread that you're weaving is that Mark, his strategy was not predicated on any of the fundamental information that Taleb might be projecting or thinking could happen with the pandemic. Mark's strategy was completely systematic, correct?
Right. Mark's strategy never changes. Some people don't believe that, but he's always putting on the same amount of risk protection.
The thing that strikes me also, and I've not spoke to Mark, but I've always assumed Mark and Nassim were both active Chicago guys. They knew the futures trading floors. More futures trading guys in my world, the trend following guys, they all know the same people. I've always assumed that Mark, most likely, since trend following as a strategy has been around for decades and decades, long before Mark or any of us, I've always assumed that he looked at something like that and said, hey, this is interesting. This strategy does really well at crisis times. And he chose to execute a strategy like that, but went the option direction instead. I've never had a chance to ask him that question. I don't know if you want to add any thought to what I just said.
Mark would vociferously deny that he changed anything in his trading book in early 2020.
No, I don't mean that. I'm just saying, in general, his strategy was designed from the beginning to make money from crisis times, meaning he knew whether it was 2020 or 1998 or 1995, his strategy from the ground up, not unlike these strategies that I've written about trend following, I think they're just using a different way to get to the same goal, except Mark seems to have, I don't know any trend following traders that made 3,000% in early 2020. That's pretty outstanding.
Maybe Bill Ackman was the one other person who did that. And there were some other hedge funds that had similar strategies that posted pretty strong returns, similar to Universal, but nothing like it.
Ackman, though, would be more of a fundamental guy, discretionary trading, not systematic like Mark Spitznagel.
Totally. Almost the exact opposite of Spitznagel. He saw it was coming early on. That's one of the key tenets that I try to get across to readers in the book, is that if you're going to be successful in these things across all sorts of various risk parameters and threats, you need to take action very quickly. When you see it, you can't wait, because if you wait, you're going to get rolled over. Bill's trade was based on his perception that COVID was an existential threat to humanity and also the stocks that he owned. He just bought a lot of protection using derivatives, just like he did in 2007, 2008 on the home building industry. It's a unique strategy. Universal can go years without posting any profits, in fact, losing year after year.
That's very similar to the trend following world.
Yeah. The idea is to limit those losses.
It's a fat tail approach. You're looking for fat tails and you don't know when that's going to happen. You can't predict that. Now, what's interesting about Ackman is taking a more active approach, a discretionary approach. Here you have your new work. You've got a soup of different strategies and different thinkers all trying to get to the same place.
Right. Trying to protect their investors from major catastrophic losses. That's where they all overlap. And they have different ways of doing it. Universal is the one that will always work, no matter what happens. Part of Mark's thesis is that he can't predict these things. He doesn't need to predict them, because if he's always got the risk protection on, like you would have fire insurance on your home, you don't see sparks in the distance and go out and buy fire insurance. You know that the fire could come when you least expect it, so you always keep that insurance on.
Did you have a chance to go backwards in time and start to think about these other events, these other crisis periods, or were you primarily focused as a snapshot on this window of time and looking at the people that really excelled in this window?
I tell the full story of Mark and Nassim going back to the 80s when they both started trading and started getting experience. Mark started trading on the Chicago Board of Trade as a cub trader, where he learned under some of the old veterans of the futures pits, the bond trading pits and corn trading pits. He really learned from a gut level how to trend follow, basically. He didn't have this crisis strategy at the time, but what he was taught at the time by his mentor, an old corn trader named Everett Klipp, that you need to cut your losses immediately. If a trade starts moving against you, just get out of it right away, cut your losses, move on.
David Ricardo's, the British economist, was 1700s, his maxim: cut your losses short, let your profits run on.
That's what every cub reporter at the CBOT is told. But Klipp was very aggressive at getting this into the brains of his trainees, and Mark learned it well. Nassim at the same time was coming up as a derivatives trader in New York. He sort of become this famous mega trade on Black Monday and the following day in October 1987, where he had positions, he told me this, that he'd bought for pennies on the dollar or dollar that went to $400, $500 in a day. It was a trade that, according to normal statistics, the bell curve shouldn't occur in like 5 universes. They're so unlikely, they're off the charts in terms of the probability.
As Benoit Mandelbrot said during his lifetime, these happen actually a lot more frequently than people expect.
Yeah. Nassim, I have a scene where he first meets Mandelbrot in New York at a lecture that Mandelbrot was giving in, I think it was 2002, 2003 at NYU. Nassim became infatuated with this idea that you could apply fractal geometry to what he was doing, because what Mandelbrot was describing was the exact experience that Nassim had had a number of times, where things happened that just shouldn't happen according to the normal distribution. Nassim had already figured that out, but Mandelbrot gave him a new way of looking at it, and they became good friends. They lived near each other in New York and wrote some papers together. There's definitely an overlap between Mandelbrot and Taleb.
I remember the classic, I call it a classic, but there was a classic article, and I think this was before Nassim's books, the Gladwell article where Nassim goes to visit Victor Niederhofer. Do you remember that piece?
Yeah.
That was one of the most interesting pieces of writing for somebody like myself at that time, trying to understand this world, and for Taleb to go there. And Niederhofer was like the best guy.
Oh, he was the best. Yeah.
Yeah. So fascinating to be in Taleb's headspace at that moment in time, witnessing what he saw there. Fascinating stuff. It's the nonlinearity, the inability to predict, except, okay, we can say that Bill Ackman was using discretionary judgment. But I think overall, as you make the point with Spitznagel, that it's these strategies that don't predict and are kind of systematic and can't determine when the next crisis alpha moment or chaos moment is going to happen. Those strategies, rooted in the whole cut your losses and let your profits run, those are probably going to do pretty well for a significant period of time into the future, because essentially they're all rooted in Kahneman's work.
Yeah. I mean, there's definitely overlaps with Kahneman, and I think Nassim and Mark would both agree with you that there's loss aversion that people have. They don't want to lose on their trades. And that's what this trade is losing over and over and over again, months, years at a time. It could be very psychologically difficult to do that, to go in day after day. And that's what Nassim really couldn't handle in the first hedge fund that they launched, Empirica. Was they did really well when they launched because the dot-com bubble blew up, and they launched in 1999. Mark said they were making money almost every single day, which he said a trade like this really shouldn't happen. But they did really well. They got off the launch pad like a rocket. But then 2002 came, the Fed cut rates, volatility died. It was just a slog. After a couple of years of that, Nassim couldn't take it, and he shut down the hedge fund. There's definitely behavioral overlaps. And Kahneman and Taleb, I have another scene where he meets Kahneman in, I think it was Rome. Nassim gave a lecture to a bunch of Italian and French financial people, and he basically told them they didn't know what they were doing. They didn't understand the risks that they were taking. And he felt like he was getting a very chilly reception. And Kahneman followed him on stage and came on and said, I have some remarks to say, but first of all, they will all be in agreement with the previous speaker. And Kahneman had just won the Nobel Prize for economics. So that made Nassim feel pretty good. Then he got to know Kahneman and they became friends and still are today.
Let me ask you, I don't know if it's considered controversial. I was not aware of this conflict until I'd seen a few things on Twitter, and then reading your book, I saw more of this. And I don't want to get into the spitting match, I'll call it. But if I look at Cliff Asness and Nassim, look, both of these guys, and I know Mark has written a book, essentially, I'm reducing here, Libertarian Economics. Cliff Asness is probably in a similar headspace. Nassim is probably in a similar headspace. Cliff runs Trend Following Money. Essentially, there's a crisis component there trying to get the same thing. What's the disagreement that Nassim and Cliff are having exactly? Because from my perspective as an outsider looking in, I've seen them both say, and I don't know them intimately well at all, but I've seen them both say a lot of things publicly and have read papers by them. They're both very smart guys and they both provide great insights. What's the conflict?
I know Cliff. I haven't spoken with him in a long time. He was one of the main characters in my first book, The Quants, which Cliff didn't like.
I saw a comment from him and I didn't understand what the context was. He didn't like something about you either.
I mean, he got very upset at the time because he alleged that I was conflating what happened with quant hedge funds in 2007 with CDOs, which the book does not do that. It clearly delineates the specific systemic issues with the different strategies. But in 2007, there was this big so-called quant quake where all these trend following hedge funds came close to blowing up. Some people looked at that and said there's some systemic risk here in what these funds are doing because they're all emulating one another. And if there's a spiral effect that forces them all to delever, you could get billions in losses that spreads to the larger economy. Andy Lowe, an MIT quant expert and economist, wrote a paper claiming that we have systemic risk here. That's in the book. And then there's other parts of that book that are specifically about the housing market and the derivatives and some of the traders involved with that, and looked how these are also quantitative strategies. There's some similarities, and we clearly had massive systemic risk there. I don't know if Cliff ever read the book.
What about today, though, in terms of Taleb and Cliff? Because like I said, I think most people that follow this space, financial Twitter and whatnot, I think most people, if they're being honest, would say, hey, this guy Asness and this guy Taleb and Spitznagel have some very smart things to say, independent of each other.
AQR, it's a very academic-oriented hedge fund. They write papers about various strategies. They've written over the years strategies criticizing the universe tail hedging strategy, or just the generic tail hedging strategy, analyzing various market mechanisms that you can look at publicly, like the VIX, which is a proxy for volatility, or looking at various options, out of the money options. I've talked to Mark about this. I haven't really gotten into it with Nassim that much, but they say that AQR is misrepresenting their strategy in their papers, and that they in fact don't know their strategy because it's proprietary and it's based on decades of on-the-job experience learning these markets and how to operate them optimally and efficiently, and that the papers don't reflect what they're actually doing.
That's one part of it.
Yeah. What happened in 2019 was that CalPERS, the big California pension fund, had invested in Universal. They'd become their biggest investor with billions of dollars in Universal. A new fund manager took the helm in 2019 and decided to exit the strategy. He decided to exit a lot of strategies. One of them was Universal. In a call, he justified his decision based on an AQR paper criticizing the tail hedging strategy. That got Nassim upset that CalPERS had made this decision and partly justified it on this AQR paper, which Taleb, he's very critical of. He attacked it. Cliff decided to respond to the criticisms on Twitter.
Two heavyweights punching each other.
A hedge fund titan Twitter battle where they both really went after each other. In the book, there's a few pages on that. Cliff is a temper. Okay, so does Nassim.
What is Cliff's argument, though, against the tail strategy? Again, I know Cliff is practicing trend following approaches, which you could say are tail strategies as well, looking for fat tails as well. What is his specific criticism of Mark's approach? If you can summarize it.
That it loses money over time. Basically, their analysis is you're spending too much buying these options over time. And when you eventually get the tail event, it doesn't make up for the losses that you incurred putting on the strategy. Universe's experience shows that that's not true. They've written letters to their investors that have become public that analyze the long-term returns of the strategy. It shows pretty good gains. But this is one key to the strategy that Mark has talked to me about over and over again that most people don't get. It dovetails with what happened at CalPERS. Every big fund has hedging built into their portfolio, some kind of hedge. A lot of it is usually treasury bonds. If you have T-bonds as your hedge against a downturn, you need to have a pretty big chunk of your portfolio in bonds. There's the classic 60-40 strategy. So you have 60% in stocks and 40% in bonds. If you have that strategy on during bull runs, you are losing out on the upward trend of the market. And the market usually, as you know, is going up over time.
If we're speaking specifically of equities in the US, for example.
Yeah, S&P 500. Mark looks at that and says, you're leaving money on the table. If you get a Universa tail hedging strategy, you can put 3% of your cash into that strategy and the rest into something more risky like equities. You can put maybe a little bit in bonds or gold, but it gives you a lot more room to run on the stock market with this strategy. He's analyzed this over and over again. This strategy, according to his analysis, and some others have replicated it, you get a lot more in the upside when the market's going up. And this is why he says, I'd be fine if we never have a crash again, because my investors are getting the benefit of having this much bigger exposure to the equity market than somebody who's got a 60-40 strategy, which is very popular among pension funds. CalPERS went back to doing something like that, as well as putting more money into private equity, things like that, which are risky because they're highly levered. In the downturn, your private equity stake might not do so great. It's not a great tail hedge.
Let me ask a question about performance. The 3,000% figure or 4,000%, whichever it is, either one, it's massive. One of the things that I've done over the years, which really helped me to understand the futures trading space, specifically these trend following type strategies, was seeing the performance data generally on file with the CFTC, seeing that month by month performance data. Now, look, I know there are some great traders. Mark might be one of them. I know Jim Simon's trading data is very hard to come by. But in terms of Mark's data, that 3,000%, have you had a chance to see that month by month stuff? Because I'd be fascinated to see. Now, it might be something that's private. I get that. Have you had a chance to see that?
For those few months, yeah, they have written the month-to-month performance. Almost all of it was in March of 2020, which is not surprising.
Literally, though, his strategy is going to be smaller negative months until the next crisis moment happens. And then he's looking at the outsized move. Is that what you would generally expect if you're invested with Mark?
Yes. You're going to have a lot of months that position is declining. You're losing money on it. And then something very large. Part of this also goes to the claim that Nassim and Mark discovered long ago, which I think a lot of people have had trouble getting their head around, is that the 5% losses, the 3% losses, the wiggles in the chart as you move slowly upward don't matter that much to your long-term performance. What really matters is the black swan event, the crash, when your portfolio goes down 30% or 40% or more.
October of 2008 for long U.S. equities people.
Exactly. The dot-com crash. Those are things that are really hard to come back from, because if you lose 50% of your portfolio, you need to make 100% to get whole. It can take years to crawl out of that. Whereas if you had protection against that devastating impact on your portfolio, you sail through that. I've talked to some risk managers who've known Nassim and watched over the years. Aaron Brown, for instance, is one who I quote in the book. He worked for Cliff at AQR, and he was a chief risk officer at Morgan Stanley. He told me risk managers usually spend most of their time thinking about the day-to-day risks. Then they'd use part of their time, like 5%, thinking about the big crashes. But that really wasn't what they were looking at primarily or concerned about.
If you're just an index trader, if you're just long only equities, by definition, how can you be somebody that's set up to benefit when tails happen? The strategy is just basically buy the market. There's no tail mindset in the typical index investor, whether they be a mutual fund or a pension fund. There's no tail strategy built in.
Yeah, which they would say is a mistake. You're setting yourself up for some pain down the road. That's what Aaron says. Nassim showed people is that you really need to think more about the big crashes because those are more important, because if you don't survive those, then you're done.
There's another concept here that dovetails in with what we're talking about. I think people have a real struggle with this, is the idea of lumpy returns. Just the phrasing, the idea of lumpy. No, people want to imagine this nice straight line that goes up and never comes down.
Well, that's why I get into this in the book. Modern portfolio theory loves that low, volatile, steady gain type of return because you get a high Sharpe ratio and it really looks good on paper. That became very popular, as you know, on Wall Street. And that's why Universa hardly could raise any money when they first started raising funds in 2007. They got an initial couple of investors, and then it went more than a year after visiting everybody they knew on Wall Street, first crossing the US and Europe. Nobody liked it because it was lumpy and it looks terrible on a balance sheet. You got this negative return year after year. Portfolio managers want to maximize that. They're thinking, what am I going to do this year and next year? They're not thinking, well, 10 years from now, there might be a crash and this thing will really benefit me. That's not even in their universe of thinking of portfolio construction. They had a hard time, but they were lucky. They launched into the global financial crisis. In 2008, they performed spectacularly well. I wrote about them in the Wall Street Journal, and the investors flocked to them, of course.
Same thing happened with trend following. They all flocked to it. Like, for example, Winton Capital out of London got to 30 billion under management after 2008.
Those strategies didn't do so well for a couple of years, and they started losing investors. It's a hard strategy for portfolio managers to stick with. So you saw with CalPERS, same thing happened to CalPERS.
The funny thing is all these people have Kahneman's book, but none of them actually either understand it or believe it, one or the other. But they all have the book. It's on their shelf. They can say, I've got Kahneman's book here, but none of them believe it or follow it, one or the other.
It's partly because Kahneman is showing that those type of behaviors are human. In a way, you're asking people to behave against their own instincts, which is why Mark is so big on talking about discipline, is you have to fight your own instinct that you're losing. This is millions of dollars, not a small amount. To put on a strategy that can protect billions of dollars in equity is expensive.
You've got other people that you've discussed in the book. Someone that was been on this podcast before, Didier Sonnet. He's an interesting guy. I remember the podcast somewhat. It'd be very different than, let's say, Spitznagel, Taleb, or even Cliff Asness, where those guys are saying, hey, we can't predict tomorrow. We've got a systematic strategy that will most likely benefit when the next chaos moment happens. Whereas Didier says, I can wrap my arms around it and make a prediction. Is that a fair assessment of how he looks at it?
Yes. He's about predicting the so-called dragon kings, as he calls them, his black swan.
How does he respond, or how do you sum up his response to, okay, Asness, Spitznagel, Taleb don't think they can predict. How does Didier respond or deal with that?
He's very antagonistic to that approach because he thinks that a lot of these things are predictable. You could see in 2006 and 2007, there was a major housing bubble that was imploding.
The Big Short movie, Michael Burry, right?
Yeah, there were people that predicted it. John Paulson made, $12 billion predicting it. He thinks that the black swan lets people off the hook for responsibility. Well, the world is just completely unpredictable. We never know what's going to happen. And this crazy thing happened and I didn't know it. Nobody could see it coming. Whereas his way of predicting things is far different from something that John Paulson would have done or Michael Burry, because they were digging into the guts of the derivatives and the CEOs and all that stuff, seeing that these were houses of cards that were going to come tumbling down. You bet on them, you make a lot of money. Didier is using very sophisticated mathematical strategies based on high performance physics to look into market volatility and see signals that show something really crazy is about to happen.
Does he have the track record over time that some of the other names we've been talking about in this conversation have?
I would say he does not. He's not a hedge fund. Hedge funds have used a strategy. Like many hedge funds, they're quiet about whether it works or not. I've heard some people say it has worked, some say it doesn't. He claims that he's made money on some predictions. There's an anecdote in the book where he and some of his students got together some money and set up a interactive broker's account and started trading. He tells me they did very well, but he got too obsessed with it. He felt like he was becoming a hedge fund manager and he didn't like the state of mind that it put him in. So he just shut it down. He says, everybody tells me, Didier, how come you don't set up a hedge fund? He says, why should I? That's people saying that the best thing in the world is to become a hedge fund manager. I've got the best job in the world. I get to look at the entire universe science and research it. I love what I do. So why would I set up a hedge fund? I could get that. The reason I contrasted the two in the book is that it just shows that there are different ways. People say you can't predict the market. There's a lot of experience that traders have had over the years to suggest that. But that doesn't mean we should just throw out that attempt, because these strategies are evolving and maybe there will be ways to detect things coming, not just in the market, but Didier looks at other phenomena in the world. If we do improve our ability to predict things, perhaps we can mitigate them to a certain extent. There's a whole field of research that's doing that. The work Didier comes out of that I get into with some other characters, the complexity theory, which is using very advanced math that I can't say I understand, but looking for patterns. They look for patterns, whole realms of phenomenon data to try to predict something like a famine or social unrest or climate change, and use that to say, well, this pattern that we're looking at, there's a crisis in food supply that indicates that there's going to be unrest in this part of the world, and maybe we should start thinking about sending people over there. And that's actually a thing. I mean, people were doing that. It's not just applicable to the market, but if there does develop a system to be able to detect crises, and I'm sure the Fed has things like that in its toolkit.
A guy like Spitznagel would say, not part of my deal.
Yeah. Mark would say, fine. In the book, I recount a debate where Nassim and Didier are sitting right next to each other and going at it. It's really illuminating in terms of how they look at things. And in some way, you can see they're talking crosswise. They're not talking about the same thing. Nassim is saying, what you have here is really interesting. And maybe I got that signal. I might buy some options, but this is not an efficient way to manage risk. When you're managing risk, you can't be using some parameter like GDP or inflation or interest rates to make predictions, because you're always going to be wrong. You need to manage your position. That's what matters, is the position that you take.
And that means price. That's the price of the instrument. That's all you can manage. That's how you measure your losses too. It can't be some theoretical, I've got these 5,000 different fundamental factors. The trend following people or Asness or Spitznagel or Taleb, I'm sure they would probably, I'm putting words in their mouth, but they would probably argue that it's all embedded in the price to begin with.
I think so. I think that Mark and Nassim would say that the options that they're buying are cheaper than they should be. And that's why they think their strategy works, is because what they're betting on essentially is something that's so out of the realm of possibility, or at least to most people, they're dirt cheap and you can just snap them up for nothing. The funds selling them are just like, hey, this is great. I'm getting steady returns for nothing, because the S&P is going to go down 20% a month, which is essentially what the universe of bet is a 20% decline within a month.
In our time left, I'm going to go down a path with you, because I think this is an interesting aspect to this work. I think you could have, this new book, you could have left this right in the headspace of where you and I are talking right now, which I think would probably cause people on the left and the right to feel no discomfort because it's not political. But you definitely have a bias. You do not like Mr. Trump. I can see that clearly.
No comment.
Well, if they read your book, they're going to know.
Well, I would say, just in terms of the outcome that the United States faced in 2020 with COVID, was not optimal. Our country saw the most deaths of any country, which flabbergasted me because I thought we're the most advanced country in the world.
We're also the most obese.
Yeah, yeah,
That was the primary issue, unfortunately.
that was an issue. But the administration made wearing masks political. They made getting vaccines political. These are not political things. So I think that was a failing that emanated in part from the administration.
You know what's interesting about that thought, though? Here we are in 2023, and I'm currently in Asia. I've been in Asia for essentially 10 years. I don't think the average man in the street really has a strong, I know this for sure feeling about whether or not they should take a vaccine or wear a mask. It seems like we went through this entire process on the backside of it. I don't know what works or doesn't work, frankly. How does that sound to your ears when you hear that? It seems like a fair assessment that most people really don't know still, all these years later.
I would say that definitely people should get a vaccine. If you're in an area of high transmission of a deadly disease, wearing a mask makes sense because what's the harm?
That was my logic in early 2020. It's not my logic today. Let me throw something else out on the table, which I think is really interesting that you wrote about. And I would love for your comment because, like I said, you've got some strong opinions. It's an interesting mix of things that you've laid out. You did bring up the George Floyd case, and I would love for you to comment on something. You're a guy that looks at how media shapes. And you're right. When the George Floyd situation happened, I'm currently in Saigon, Vietnam. A lot of people in Saigon, Vietnam know about the George Floyd case. CNN is around the world. People know. The thing that's interesting, I would love for your comment on this because maybe it takes us to some place that is useful. There was a young guy that was killed in Memphis recently. Instead of being killed by a white cop, he was killed by 5 or 6 black cops. That got no coverage. That's the thing that's interesting about the media. And I would love for you to comment about the media because sometimes it feels like things are not just happening in a vacuum. There's some buttons being pushed, so to speak. There's some narratives being pushed. Even you've got some strong views in your work. How do you see the media machine in the context of all of this chaos that we are living through?
As a longtime member of the media, I definitely see that we gravitate towards things that are negative and are controversial. Writing about last weekend's birthday party for little Cindy isn't going to get on the front page of the Wall Street Journal.
It's not going to get eyeballs and not going to make money.
But that's normal life. The things that people experience in normal life aren't things that get covered in the newspaper. We're saturated in bad news. That's the DNA of newspaper coverage. Experienced reporters try to be cognizant of that and not hype up things as much as they possibly can. I see my job as a reporter as trying to highlight trends. Right now, I write about climate and climate technology. A lot of these stories that I'm looking at are really interesting and upbeat stories about investors finding new things in technologies that can help us get through this period. But then there's the dark side of that, people covering the disasters and the storms and heat waves, all that. There are good and bad sides to all sorts of stories, but there are some that thrive on the chaos. I would say in recent years, there's been a lot of that that's come from the right side of the political spectrum that's hyping up racial tensions. But I can see people saying, well, the left does it too.
Somebody could say easily with George Floyd, like, hold on, this is an extremely rare thing where the white cop is killing a black man. Whereas on the other side of the equation, when you look at USA crime statistics and you look at that case in Memphis I just mentioned, people might say, hey, hold on, why was this not covered? Why do people in Asia not know about this case in Memphis? I think that's the frustrating part for people is people start to think, people think there's a button being pressed.
I would say that's ridiculous because the news media is just multi-headed hydra of all sorts of different buttons. There's no single button. The Tyree Nichols case in Memphis did get a fair amount of coverage here in the U.S. I saw a lot over a couple of weeks.
But nothing like George Floyd.
I would say George Floyd was a global phenomenon. I mean, people were protesting the streets of Paris.
Why, though? Why?
It came during the outbreak of COVID. It was an extremely difficult video to watch.
So was the Tyree Nichols, just to push back. And I think you could see what I'm pushing back on because it's always a different side to these conversations.
There always is. I agree. I don't want to get too deep into it. I try to stick to what I know. I'm not a reporter who covers race relations in the United States. I don't want to speak out of turn. I think that the George Floyd thing, it lit a fire. There was something about it that just caused people to just heads exploded. I guess you could say it's like a black swan thing. It became exponential. It spread like a wildfire. It became global. Why? It's hard to say. I mean, it was a horrific thing. That video really did disturb people. I think that the Tyree Nichols video is more grainy. I don't even know if I saw all of it, but the close-up image of the man's life being squeezed out of him over the course of 10 minutes was, I think, a part of what really set things off. And also the fact that we were in this COVID situation where people were locked down, out of work. There were a lot of things going on at the time that led to that.
The reason I brought it up is not because of race relations in America, not because of it being controversial, whatever. I brought it up is because the media does have to pick events. You're in the media, but as an outside observer, it does seem like some events do get pushed. I mean, look, everyone gets to choose what they write about in the media. They get to choose what they put on the front page. They get to choose what they lead with on CNN or Fox or whatever. That's what I'm driving at. Regardless of what the issue is, there are decisions being made about where we put the concentration of effort. And ultimately, those decisions are going to have a chance to feed into the next chaos moment.
In any news organization, you have a hierarchy of editors leading up to the owner who are making those decisions. My experiences with the Wall Street Journal, I know kind of how the New York Times works and other outlets. It's an art, not a science. It's people trying to think like, this is a really interesting story. This is why we think it should deserve placement at the top of the website and stay there, or goes inside the paper. That is often a decision that determines whether something gets a lot of attention. But then you can have stories that are not played up at all, but they catch on Reddit or something, and it takes on a life of its own. It's a rough beast. It's hard to control. But I would say at the highest echelon of media, I just think it's people making their best decisions about what they think is newsworthy based on their understanding of what's going on in the world. Certainly, you can't throw out biases for anybody. I see it that for a long time at the Journal, we had a hard time writing about global warming and climate because there's just an institutional aversion to that. But it became a business story, a multi-trillion-dollar business story that was impossible to ignore. We started writing about it a lot, not just the business side of it, but also the climate side of it.
Let me ask you just an interesting thought here, watching Silicon Valley Bank and First Republic Bank and watching how these events have unfolded in the last couple months, essentially starting with, I would characterize as active investors in Silicon Valley Bank or VCs associated with the bank, essentially creating bank runs. So there's another example of not necessarily a New York Times or Wall Street Journal media operation, but kind of a Twitter media operation of where things can spread quickly.
Yeah. I mean, they're bank runs, but they're bank runs on steroids because all those investors know one another. They're all following the same Twitter accounts, communicating over Slack. The Silicon Valley Bank definitely was something that happened with speed of light that you could attribute to social media networking effects. It's spread to these other banks as well, but that one, without a doubt, had that feel to it that there's something that caused all of these investors to pull out on the same day, $40 billion. I haven't followed every twist and turn of that story, but I do know that a lot of those investors were talking to one another.
I got to think you've come into a very interesting topic. There's some interesting color, and I'm sure some people are going to say some things are controversial and whatnot, all that fun stuff, but it makes for an interesting read. For me, again, as somebody who's written 8 books on trend following, which essentially is in the same headspace, it's just Universe's performance in that particular month was out of this world. That's just amazing.
That market was really crazy. I mean, I remember just sitting there at my desk in DC watching the Dow go down 2,000 points, then up 2,000 points. It almost felt like, oh, down another 2,000 points. Definitely one of the most bizarre markets I've seen. I've seen some crazy markets. I mean, I first came into financialjournalism.com period, and that was pretty nuts. I think 2008 was worse. than 2020 in its long-term effects because it took out the financial system for years. But that one month in March and April, that was some crazy stuff. I think it might be more crazy is that it stopped. I remember the reporters and editors see around in the summer of that year going, why is the market going up like a bat out of hell? We got 20% unemployment in America.
This is not a prediction, but when I look around and make my observations of things, and even though I'm a price action guy, I follow the price, but if I kind of just blur my eyes and look at the macro econ picture, it would not surprise me if we have more chaos in the not too distant future.
I have that feeling too. I feel like I always have the feeling now. My side was Mark that I can't predict things. I do find myself expecting things to happen. I remember in the 2010s, it looked like there were some really, really bad things going on in the European countries with Greece and others, and Italy. It seemed like Italy was going to go down. We went through that. The Fed is tightening into what could be a recession, which is not normal. There's a lot of debt that need to be repriced. And I think that we don't know, but there's certainly the chance of something pretty spectacular, not in a good way, happening.
I'll put a pin in us at that moment. People should check out your book, Chaos Kings, How Wall Street Traders Make Billions in the New Age of Crisis. I might quibble with you and say it's not necessarily a new age of crisis. These crisis ages have been around for a long time. But again, Chaos Kings, How Wall Street Traders Make Billions in the New Age of Crisis. Scott, where can we send people? Where would you like to direct people? They can buy the book on Amazon. Where would you like people to go to check you out?
You can find me on Twitter at Patterson Scott, and I've got a website. It's scottpattersonbooks.com.
Was this the first book since the last book?
This is the first book since Stark Pools, which was 10 years ago. It's been a while coming.
Well, cool stuff, man. I appreciate you coming on. Thank you.
Thank you, Michael.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.